This was announced in combination with the province and federal government that they were putting up an $8.8 billion fund. It's roughly going to drop cost of development charges by around $30,000. So combine that with the HST rebates that are up to 13% off. It's like these are massive in your pocket savings.
You're listening to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. And now, here are your hosts, Paul Stevenson and David Warren. Hello and welcome back to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. My name's Paul Stevenson. I'm a Level 2 mortgage agent. I'm joined by David Warren, Level 2 mortgage agent and owner at Referral Mortgages. We are back. It is July 21st. Crazy. We're end of July. The market is lots of headlines this week, Dave. Let's get right into it. How's your week been? What's been going on? How are you?
I'm doing all right. Like you said, it has been a little bit of a quieter week, it seems. What we kind of expected, but at the same time, thought it might have been a little bit busier than it has.
Yeah.
But yeah, it kind of seems like everyone's certainly in that vacation mode. I know at least a number of our friends are off work, dealing with kids being out of camp or dealing with that. But yeah, what have you been seeing? Have you kind of been seeing the same, like slower on your in your neck of the woods as well?
A lot of cottages, a lot of people at cottages, not buying them, just kind of out and about. I think, the biggest sign of this, Dave, was that last week, Bank of Canada, big rate announcement, didn't hear about it from anyone. It was just kind of, it was like, there was a headline here. We obviously heard about it being in the industry, but throughout the year, typically when the Bank of Canada has a rate announcement, anyone that's in real estate online is posting about it. They're sharing stories. Or this is what's happened. Now's the time to buy. It's always been the catalyst that gets people moving. But last week, Bank Canada announced no change in rate, which is kind of what we expected. But like I said, you didn't really hear much about it. It was a pretty stagnant week. But to be expected. I mean, we actually this is the first year we've actually recorded shows in July. I think in the last 4 years. Because July historically is just a slower month. So we just, we kind of take the month off ourselves. But this year, like July and August, I actually do have a fair amount of closings, a lot of them being like refinances, renewals. There are some purchases in there. But, historically, these are slower months. So those, July and August closings were actually started in kind of April, May. So they're not, new deals that just came on my plate this week. But there are still a lot of people shopping, a lot of August closings that are still, coming to the table now. So all this to say, still business happening, not as busy as maybe a month ago, but to be expected. As you said, nothing in there that's like surprising. This is kind of the time where you tell yourself, it's summer, relax, eh?
Yeah. Like you said, Bank of Canada rate announcement wasn't anything we were not expecting. Sixth hold in a row. But what was interesting was the inflation numbers that came out yesterday.
Yeah,
which kind of tie into those Bank of Canada, that announcement last week, because they came in lower than expected.
Yeah.
And that has some people kind of talking and thinking, and obviously we'll see what it comes of in July, but talking about, could the reduction in the inflation rates actually lead to possible reductions in bank prime, but from the Bank of Canada. And that's obviously a flip from a month and a half ago where, economists talking about an increase later in 2026, early 2027. So obviously these all change month to month, but maybe you want to kind of touch on what was announced by StatsCan with regards to inflation.
Yeah, absolutely. And I always think it's funny when those numbers come out because, something like this is a headline and like, well, now there's a 90% chance rates are going up, and then next month, new headline. Well, now it's about 35%. It's like, it's just wait and tell us when it's time. It's just so ridiculous. So yeah, so in June, the inflation actually fell more than expected. Economists were expecting kind of like 2.9%, and inflation actually slowed to 2.8% in June, which is down from 3.2% in May. And what caused it? The primary driver was gasoline. So gas prices fell 10.2% from May to June. Oil prices eased, as we talked about. We've kind of talked about that. This has been the crude oil podcast for the last month and a half. But I think this morning it was sitting around $85 for crude oil. So, that is up from, I think when we did the show last week, it was around 74, 75. So like, it's all over the map right now. But specifically in June, the gas prices fell 10.2%. I mean, we were sitting, about $1.80 a liter at one point. And I think it's down to, 150 now or so. So we have seen a pretty substantial drop. They remain 20.5% higher than a year ago, but that's much lower than May's 33% annual increase. So the other notable changes: grocery inflation, 3.9%. So that's down from 4.3. Shelter inflation was 1.5, which remaining below 2% for several months now. And then travel costs jumped as the FIFA World Cup boosted demand. So travel accommodations were up 10%. Travel tours were up 7%. But again, not overly surprising considering we had an international sporting event here. That's kind of where you would see those things uptick. So, this report supports the Bank of Canada's view that the recent spike in inflation was largely driven by energy prices rather than broad-based inflation across the economy. While the bank recently held its overnight rate to 2.25%, which we just talked about, softer core inflation suggests there is less immediate pressure to raise rates, although policymakers remain cautious because of ongoing uncertainty surrounding global energy markets and geopolitical events. So not to again make this a big political show, but there is still uncertainty in the Middle East. There's still a lot of things happening with tariffs, which I know you wanted to touch on, that have just been imposed this week. So there's so much happening. There's so many headlines. It really is hard to get a grasp on exactly what, how this impacts the real estate market. But we're kind of giving people, I think, like real on the ground data as to what we're seeing day to day, because that's really all we have. Ottawa is obviously a bit of an insulated market, but there is a lot of uncertainty in a lot of different areas and a lot of different industries, which typically causes people to hesitate, reflect, and in a lot of cases not take action versus take action. So that, I think that is also playing into a lot of the kind of stagnation that we are seeing in the markets when it comes.
Yeah, I mean, with the the positive numbers in inflation that came, lower than expected of 2.8, really, like you kind of touched on it, it obviously eases that pressure from the Bank of Canada, or at least in the mortgage world, the concern of a increase to bank prime. And so those that have variable rate mortgages, which right now is the most popular mortgage product, we're back, it was at fixed because we obviously had that spike in bank prime for quite a period, and then that easing. So people went fixed, not wanting to deal with that again. But now, because of that spread that we've talked about on past episodes, variable rate mortgage products are the number one product right now for borrowers. So this is obviously good news in that, like, rising inflation numbers, would put pressure on the Bank of Canada to raise that. So it easing is helpful there. However, things that won't be helpful is, ironically, the day after Donald Trump and Mark Carney were together at the World Cup finals, that Donald Trump announced a 50% tariff on Canada over and above what we already are seeing. So it's roughly on about $20 billion in U.S. goods, and it's going to come into effect August 19th. Now, we've talked about in the past, and a lot of people already know that the CUSMA or USMCA, whichever you want to call it, came up July 1st, and now it's in that renegotiating period every year for the next 10 years. But this is over and above that, and they're using it to, like, Donald Trump was kind of touching on three main complaints that he had with regards to Canada and trade as a trading partner over and above the USMCA. So he commented on Canada charging tax on imports of U.S. motor vehicles and restrictions on the number of vehicles coming in that are not covered under CUSMA. Dairy being like a prolonged problem for the U.S., specifically our like supply chain management system with regards to that, which like we put foreign import limits, and anyone that exceeds those limits are charged a tariff of 300%. So Canada's always protected the dairy industry pretty heavily. And so, these tariffs and why we've seen, that U.S. dairy products not on our shelves, and it only opened up in the last few years is because that was included in that renegotiation of CUSMA. So that's the only reason why we've only started recently seeing some of those U.S. dairy products. And then the last one being the provinces that have stopped buying U.S. alcohol. So,
right.
Really it's only been Alberta and I believe Saskatchewan that have opened up as far as like buying U.S. alcohol products. Aside from that, everyone, which the LCBO is the largest buyer of alcohol in the world, I believe it is, or I should say U.S. alcohol products. It's the largest buyer or single buyer. So this is massive, and it's been creating a big stink within the different states that have been really feeling it now that it's been drawn on for over a year. They've seen those numbers come out. of it really hitting their bottom line as far as like in those states in particular. So Donald Trump kind of pointed to those and as the reasoning for being able to invoke, a US tariff act, dating back to 1930 and kind of putting these additional 50% tariffs on, which are really hitting, kind of a wide ranging number of industries. So everything from Canadian wine to hockey equipment to cement to furniture to clothing. Really, the only things that are exempt are energy products, potash, fish, critical minerals, basically things that the U.S. obviously needs and lacks that they're not imposing those on. But
Right.
we're seeing it hit on everything else. So, kind of the question for those listeners out there is, are you in any of these industries that are going to be hit with these additional tariffs? Because, really on steel, it's not on top of that 25% tariff that's already there. It is replacing it. That's now going to be, a 50% tariff on steel and aluminum, things like that, softwood lumber. So, for those listeners out there, like, how do you think that this is going to impact you as either whether it be in your industry or you as just a citizen, and how it's going to affect our GDP and affect our industries? Because yes, we saw inflation come down, but if we start to see GDP and our exports decrease significantly, and this actually comes into effect in 20 days, basically, that's going to be, or I guess 30 days, that's going to be a massive hit to our economy overall. And how does that play into the Bank of Canada's decisions kind of going forward?
Yeah, and I guess like what has been the response from Mark Carney like after this was announced? Because I mean, as you said, they were together Sunday. This was announced yesterday. Like, what's kind of been the general response from the Canadian government?
I mean, basically that he remains willing to negotiate and that he's open to negotiating discussions, but
Right.
that's really it. There hasn't been any talks or news of, a concerted effort to negotiate with the US. And I think that, him vowing to intensify trade talks, well, nobody knows that there's actually been any trade talks. And
Right.
Canada's dropped our tariffs, our retaliatory tariffs against the US. We're one of the only two countries to actually put retaliatory tariffs on the US. It was us and China. And so this is also what kind of angered the Trump administration, is that we're one of their closest trading partners and we retaliated against them. So that didn't put a great
Right.
taste in their mouth either on a go forward basis. So, them saying they're going to intensify talks, who knows? But, again, we've said it for over a year that, this government was elected on, having those talks, renegotiating CUSMA, getting the tariffs reduced. And now we've just seen it escalate even further, which obviously isn't good for anyone within the country. And I'm sure within our own government, they're probably taken aback by this as well.
Yeah, and I wonder, like those specific industries, like you said, wine, like hockey equipment, cement, furniture, clothing. As you mentioned, like I know energy and potash and stuff is that the U.S. needs, but I wonder, like why they chose these specific, exports. Like wine has to be, one of our number one exports to the US, or like there's got to be something where these were really the five that would hit us the hardest, or that would have the largest impact outside of those other exemptions that you mentioned.
Yeah, I mean, it's still hitting automobiles and things like that. It's really just, kind of hitting everyday consumer good items so that it's,
Right.
really kind of widespread, if you will. And, if you look to wine, we hit their alcohol industry. So it's a pretty easy rebuttal where, the US Supreme Court was against or shot down some of the, tariffs that were put on. But if we're not buying their alcohol, it's pretty
Yeah.
hard for them, for us to argue, well, you should be buying our alcohol or not tariffing it. So I think it's hitting industries and areas where it's pretty clear cut that, these are areas where we've tariffed them or we've restricted. And so there's,
Right.
not really much that we could do. So they've been maintaining those active tariffs from between 15 and 50% on like steel, like I said, steel, aluminum, copper. And then it also charges 35% tariffs on Canadian softwood lumber, and then another 25% tax on non-US car parts. So, we put a 25% counter tariff on those. It's, on those exact same things. So, it's not that, we've dropped a bunch of them, but really at the end of the day, I'm hopeful that this additional tariffs is going to spark conversation that has not happened to date. The fear, and this is going to be a fear of everyone in the public, and we're, kind of bringing it back to real estate, is that that, like you talked about earlier, like that unknown, that fear of changes in the economy, people's jobs, talks about decreases in GDP or decreases in exports can just lead to, again, that recessionary talk. We had that, come out of the last quarter, but then we had the numbers increase. Well, these come into play. That's going to slow and hinder these industries, which is widespread. And it's not just focused solely on softwood lumber, focused solely on the auto industry or anything like that. And it's going to hit a lot of different, private industries, which to the employment numbers have been what's driving our unemployment rates.
Right. Even the best photographer can't hide drywall dust and paint splatter. And every day you delay listing could mean missing peak spring pricing in Ottawa. A to Z Cleaning Expert gets your property truly photo ready. Don't risk going to market half ready. Mention TOREP at a2zcleaningexpert.com to receive priority scheduling for your next listing. Your home is one of your biggest investments, and the team at Big Westboro can help you protect it. Our expert brokers will find the perfect coverage to keep your home and belongings safe. Call 613-239-5792 or visit thebig.ca/Westboro for a free quote. Think big, protect what matters most. Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction at Gertin-Poirier Avocat Lawyers. We love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you for an effortless client experience that opens doors. Call us at 613-744-4488 or visit our website at gertinpoirierlaw.ca. Let's get to the heart of your deal. So, Dave, changing gears a bit, bringing it back home to Ottawa specifically, we recently talked about kind of the Renoviction bylaws that we're passing with City Council. I know you had an article and kind of some updates on that, so I'll pass the mic off to you here to kind of give us a bit more information on that.
Yeah. So like I talked about last week, it was proposed, it passed through very quickly through City Council, and the Renoviction Bylaw is going to take place January 1st, 2027. So for any of you small landlords, or even large landlords, something to keep in mind. And really kind of what the rental renoviction license bylaw is that, like I said, landlords seeking to evict a tenant to complete renovations on their property will be required to apply for license from the City of Ottawa within 7 days of issuing that eviction notice. In order to get that, you'll need to provide a building permit to City of Ottawa to get that to get that license. So something to keep in mind, kind of that chicken and the egg, you give that eviction notice and don't have your plans submitted, really kind of work with and talk to City Hall before maybe even issuing that eviction notice to make sure that what you're doing requires a permit. Cosmetic updates aren't requiring permits. If you're replacing kitchens and floorings and things like that, you don't need a permit for those. So to be cognizant of that, this is for those trying to just, move somebody out to just, call it that you're doing some cosmetic updates. Well, you need to be offering that unit back to that same tenant at the exact same rate as what they were paying before. So this is to stop things like that of just, improving the unit, keeping it vacant for a few months. That tenant's moved on to somewhere else and now they're renting it out at a higher rate. That's what the purpose is of this, to kind of stop that. And in this case, it's to do, those eviction would be for, that you're rebuilding the property or you're needing to do massive updates to the building, massive repairs that require a permit. So again, speak to those at City Hall. And then when you're providing that eviction notice, you're also required under this bylaw to provide an education guide that details the scope of the work and as well what they're entitled to as tenants. So just something to keep in mind as we approach that January 1st. I know it's not something that happens all the time or that is common as far as notice for renovations, but again, something to for any landlord to keep in mind. For those that are kind of in that investor, gear, but also towards home buyers. So something to keep an eye on is City Council approved plans to cut fees on development charges. So this was announced in combination with the province and federal government, that they were putting up an $8.8 billion fund that at the province for cities to tap into, that you'd only be able to tap into this if you're reducing development charges to spurn development of new homes. So increasing the supply of new homes in order to obviously, bring down costs, number one, of those new homes. So this is great news for, in combination with the HST rebate on new homes. And it was passed by council 23-1 approved this at City Hall, that they're reducing development charges by 54% over the next 3 years. So
great.
they estimate that the plan will lead to nearly 12,000 new homes built in each year by this reduction. Again, like something to keep in mind of how high this is and how this is actually going to impact you as a buyer is it's roughly going to drop prices of or costs of development charges by around $30,000. So to provide context, like single family homes in Ottawa and semi-detached homes are, for just development charges that builders are paying to the city of Ottawa, is $55,982 inside the Greenbelt and $62,568 in suburbs. So whenever
crazy.
a builder is building that single family home that you're buying for, let's say, $600,000, and it's a single family home, well, you're buying in Barrhaven, that new home, 10% of that cost is just the development charges. That's not permits. That's not the holding of the land. That's not, trades. It's not materials. That's just the development charges. So when we talk about why this is good is because really for a lot of homes, when you look at prices right now of what's out there for, even if we look at the average resale home price of $700,000, like this is what, 8% roughly, if you were taking that average home price. And that's what they're paying. So reducing that by 54% is a pretty massive number. And then development charges on like townhomes and row homes is $44,707 inside the Greenbelt and $49,000 in suburbs. So again, like these are massive numbers when we're talking about the actual cost of what the builder's charging you. So reducing that by 54%, you're getting into like dropping on single family homes 25,000, and on townhomes you're dropping 28,000, I think it is roughly. So this is dollars saved. Combine that with the HST rebates that are up to 13% off, like you're avoiding that HST up to the $1 million. Like these are massive in your pocket savings that will be really interesting to see how much this improves the housing supply, improves the trades, because obviously they've been hurting for work as well, and for home buyers as far as like options for what's out there for getting into a new home, being able to stabilize prices, reduce prices. So this is certainly something over the coming years that will be really good to see, and I think will make a big impact on the supply.
Yeah, and I mean we kind of have to give credit where credit's due too, because we've been talking about what could be implemented to kind of improve the supply issue. And one of the things we said was kind of removing some of that red tape. So between the rebates that they're offering on new constructions and this reduction in development fees, like, I mean, they are doing exactly what we've been saying it for 4 years, but it's happening, Dave. We can't get upset. This is exactly what we said would likely improve the supply issues. Dave, great show.
Paul,
lower development fees, mood boost time.
I like
We're
it.
back.
I like it.
I got 3 today. I 1 week I'm going to come with 4 or 2 or something and just throw you off, but I got 3 as usual. Number 1, how much money does a skunk have? Just 1 cent.
Wow.
Pretty good.
Wow.
Number 2, I don't trust trees. They seem kind of shady. And number 3, I once had a dream I was floating in an ocean of orange soda. It was more of a fantasy. Wow. It was more of a Fanta.
I will, I'd give that like a 2.5. 2.5 on 3.
Yeah.
Those are pretty good. The last one I was really hoping for you to finish off even stronger, but you got the half point on that one.
Yeah, Fanta. The Fanta was good. Fanta. Thank you, everyone, for tuning in to the Ottawa Real Estate Podcast. Every Wednesday at 10 a.m., we're here. We're back. We'll be back next week, end of July. Insane. But be sure to follow us. Make sure to subscribe, leave a comment, like this podcast, like this show on YouTube, and follow us on our socials. We'll see you next week, David. Have a great week.
Deuces.